Welcome to the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors podcast. I'm your host, Kieran Cavanna, CIO of Old Farm Partners. Our goal is to bring you great investors and the themes they are working on. Some are under the radar, and we think they're all experts in their disciplines. Probably the most respected investor I know who focuses on financial stocks, who will remain anonymous, once told me that the person who knows banks better than anyone in the world is Johnny De La Haye in London, long before I met Johnny. Besides being blessed with an extraordinary name for a hedge fund manager, Johnny launched his firm Hunter's Mood recently after running a global financial strategy at Tosca for the last 14 years. I've known John for about a decade, and he's done incredibly well over time. And I think it's just a very topical time to talk about Europe and banks. And welcome, Johnny.
Thanks, Kieran.
So, Johnny, to kick off, would you talk about your background a little bit, how you got to this point in your career?
Sure. And as I say, thanks for having me. Well, I started off many moons ago now on the sell side. I was a financials analyst for a couple of French firms, mainly doing UK financial companies, but some European ones. And in the second of those jobs, I met my long-term business partner, Martin Hughes. And when we were working on the sell side, our biggest client was actually Tiger. And we did a lot of work for them. And a few years into that, Julian and Andreas said, why don't you come and do financials at Tiger? And obviously I jumped at the fantastic opportunity to go and work there. I spent 3 years there. I was based in London doing European and Asian financials mainly. And then in 2000, that came to an end. And Martin and I decided to set up a hedge fund. So we set up Toscafund, launched in October of 2000, a global long-short financial fund. Martin ran that from 2000 until December 2008. I worked alongside him, and then I took over running that fund in December 2008 and ran it until I left last year. So it's been an interesting time, and I set a bit of time off last year, and having got a little bit bored and looked at the opportunity set, here I am again. And really pleased to have got Hunter's Moon Capital up and running in February of this year. And I've got a great team of people, some of which I worked with before, and we're just excited about what we can do.
Well, it certainly is good timing for many things going on. Trump presidency, deficit spending out of Germany, and banks in general in Europe being at historic valuation lows. So would you set the table for us a little bit in what you're seeing? I mean, European financials are definitely a global focus all of a sudden.
Sure. So I don't know how much time you've got, and maybe I start with a little bit of history, and then that kind of works into why the opportunity still exists. Is that, post the global financial crisis, as most people are well aware, the US government was pretty quick in bailing out the system, and obviously other big investors, Warren Buffett, etc. So the system in the US was cleaned up very, very quickly. In Europe, that just didn't happen. Yes, some governments came in and put capital into the banking system, but they didn't really have the resource and arguably the will to get the system cleaned up. So over basically 10, 15 years, you had this very, very slow cleanup process, which meant banks traded at extraordinarily low valuations. But on top of that, you had a world where interest rates fell to historic lows. And as you know, I have a chart in one of my decks that goes back to 3000 BC. And what's really, really amazing is that, interest rates have really never been where they were over that period, i.e. zero or negative. And that's just an incredibly bad environment. So you had banks that weren't cleaned up properly. You had incredibly low interest rates. And then you had a regulatory environment that was quite understandably getting tighter and tighter. Regulators were very keen that 2008 couldn't happen again. So it was kind of the perfect storm for the European banks. What's happened subsequent to that over the last few years, and really kind of we started to really identify this around the period of COVID, was that the cleanup was coming towards an end. Banks were very lucky that hedge funds had come in and wanted to buy this stuff. The regulator was forcing them to get these NPLs off their balance sheet. Interest rates started to go up, and the regulatory environment started to become much, much cleaner. And, everybody can see what that's done in terms of stock prices over the last couple of years. But, I think you need to put it in the context of how poor these businesses have been, how poor the performance of these businesses has been. And I think there's very meaningful upside still from here.
And then ironically, maybe you could talk about Europe overall. The Trump presidency was probably perceived 6 months ago as quite negative. And all of a sudden you've got the Bund, German Bund have just absolutely spiked the yields, and you might see mega deficit spending out of Europe. Is that right, that there might be a growth story emerging?
Yeah, look, I think, there's a couple of points to make. I think the first one is that not all Europe is made equal. So there was some decent growth already in the periphery of Europe, places like, Spain, Portugal, Ireland, and even Greece. We're seeing decent GDP growth anyway. And then obviously on top of that, the core, which had been the real problem, I guess, over the last couple of years in terms of growth, looks now like it will ignite. Obviously, particularly Germany, your listeners will be very familiar, but Germany's going to spend 500 billion on infrastructure over the next 10 years. They're going to spend more on defense than they have. The cap, in essence, has been taken off. This sort of so-called fiscal break has come off. And, Germany's the biggest place within Europe. So I do think that is meaningful. So I would say, President Trump, I think, has done to Europe what Europe was never going to be able to do itself. One was to get Germany to spend, but two, and equally as importantly, I think, is bring Europe together. Europe's 27 countries, which kind of want to do the same thing, but always find a reason not to do the same thing. And the pressure that is now being put upon them, particularly in terms of defending itself, is pushing it together. And it's not just about that fiscal spending that you mentioned, which I think is very helpful. It's about bringing Europe closer. So there's been increased talk of capital markets union, banking union. All of these things are upside to the current regime we're in terms of breaking down barriers, increasing efficiency across the system. So I wouldn't go as far to say that we've got an enormous growth story, but I think that when you look forward the next couple of years, there are opportunities that didn't exist before. And as an investor, obviously, I don't think those were priced into stocks.
Yeah, Johnny, maybe you could talk about this. I didn't really understand it when you explained to me the first time a year ago about the periphery, meaning like the, Ireland and Greece, and maybe not the core of Europe, but having a cheap currency and having relatively strong growth like those countries have had.
Yeah, look, again, one of the advantages, if there are any advantage of being old, is that you've seen things before. And obviously, if you go back to the pre-global financial crisis period, you had pretty rapid growth in the periphery of Europe. And arguably that's obviously what created the problems that they then had, took 2 decades to get out of. But ultimately, if you've got one interest rate, it doesn't suit every country within the euro area. And what you're seeing again is that the periphery are seeing much more rapid growth than Germany and France. I'm not saying for a moment that they only set interest rates for the core, but those are two very large economies, and clearly they've got to take that into, the ECB has to take that into account. So places like Ireland and Greece, etc., they've been growing at 2.5%, 3% in GDP terms. They've got the lowest unemployment that they've had in a very, very long time. And actually, obviously, very topically today, Ireland obviously has a large pharmaceutical industry that exports into the US, so they are slightly different. But when you look at Spain, Portugal, Greece, etc., Cyprus, these are places where services are the big part of the economy. And if you worry about tariffs, they're probably not the place to worry about.
Yeah, fair enough.
Sorry,
sorry.
The other thing I think worth mentioning here, which is very important when you think about the financial landscape, is that people forget how these economies have delevered. I think it's easy to pick out, say, Italy, which has a high level of sovereign debt to GDP, and obviously has had some issues, going back to 2016, etc., and obviously Greece. But a lot of the other countries have delevered on the sovereign side. So Ireland, for example, had best part of 100% sovereign debt to GDP. It's down at 40%. Portugal, I think, was in the 130s, is now at 90%. So, 90% by historic standards is quite high, but compared to countries now, including the US, which are headed towards 150, they're in much better shape. And then the other point to make is that the household sector was forced, because of the problems in the sovereign sector and in the banking sector, was forced to delever as well. So when I look at Ireland, you see that household debt to GDP used to be about 100, in 2008 was about 100%. It's now down at 30%. And similar numbers you can say across the periphery of Europe. So you've got a very, very underlevered. Not only have you got growth in those economies, but you've got an underlevered consumer, which means that if growth does continue to go as it is today, then you've got the chance to lend more. But what you've also got is these guys saving a lot, and I think that's one of the things that's underestimated within the banking space, and it's the savings flows that these banks are attracting, which is driving capital and risk-free returns to the banks and then to the shareholders.
I mean, it's a good way to. You recently put something out, said the stars are aligning for European banks, right? And those stars right there are household, corporate, and then sovereign. Go ahead,
sure.
Johnny. No, go ahead.
No, I was gonna say is that people spend a lot of time talking about interest rates, and I've already spent a few moments myself. But the key for me is that if interest rates are normal, financial institutions can do well. And that's not just about European banks, it's all financial institutions, from US banks to insurance companies, etc. But what people spend less time thinking about, one, they spend too much time thinking about the minutiae, which I think is generally irrelevant. But the second thing they spend less time thinking about is the shape of the yield curve, which goes to one of your earlier questions of what's going on in Germany and everything, and the Bund. That's just enormously helpful for financial institutions.
Right.
So if you think over the last 15 years, not only have we had periods of very low or negative rates, we've often had an inverted yield curve as well. And that is just terrible for financial institutions. So now we not only do have more normal interest rates for the short end, but we've got an upwardly sloping yield curve, which is hugely beneficial. And when I look at forecasts that analysts have out there, they simply don't have the benefit from that, which in some cases is exceptional in terms of the profitability that these banks can make off that.
Well, we're not going to make any stock recommendations at all, because that's not what we do here. But because we're going to get into stock picking versus kind of buying an ETF later. But could you talk about a little bit? When I looked at a name you liked last year, UniCredit, for instance, I thought to myself, "Gosh, did I miss this?" And then I looked at a 20-year chart, and you can't even see this move. It's such an extraordinary down period for financials. But maybe that's not the right way to look at it, maybe because they probably had a lot of dilution, but I'm not sure. Could you, I mean, maybe in the context of how long you think this could go, where are we now?
Yeah, I mean, it's a good question. I mean, it's funny you bring up that name because when I joined Tiger in 1997, it was, one of the trades that we put on then was in Italy was Unicredito Italiano, I think it was called, was formed out of Credito Italiano, Unicredit, and a bank called Rolo Banca. So like that was the beginning of the sort of consolidation, which now in Italy is obviously accelerating, as it were. And then for the next few years, Unicredit went out and made a load of acquisitions. It bought Pekao in Poland. It bought Pioneer. It bought HVB in Germany. It bought Yapı Credit in Turkey. It then bought another Italian bank in 2007 called Capitalia. And subsequently, the global financial crisis happened, and it was obviously a disaster. I think in 2014, if I remember, the fourth quarter of 2014, they lost 15 billion euros or $15 billion. And that was the sort of start of the recovery, as it were. And in 2016, they sold off Pioneer and Pekao. And then in 2017, they raised 13 billion euros and sold 16 billion of NPL. So it was, it's been an enormous journey through my career as you start building this franchise, then having to basically break it, raise capital. And then in 2021, Andrea Orcel joined. And I think he is probably the preeminent banker out there in Europe today. He sees it very, very clearly. I think he was dealt a very nice hand by his predecessor, Jean-Pierre Mustier, who had come from SocGen. He had done a lot of work kind of getting this business in better shape. But Mr. Orcel has done a fabulous job driving the profitability of the business forward, returning capital. And I remember in 2021 when he joined, he said that he could return 16 billion euros to shareholders. At the time, the market cap was broadly 20 billion. So over the next 3 years, he was basically going to return the whole market cap. And I remember like investors saying when I said to people, like, look, this is pretty game changing, that's just not going to happen. They won't be able to produce the capital and the regulator won't allow it. I was very convinced that the regulator would allow it and they could do it. I was wrong because he actually returned 26 billion, not 16 billion. And today he's still left with about 5 or 6 billion of surplus capital, but his market cap is now 80 billion. And if you were a shareholder then, you could have bought the shares at roughly 10 euros a share. They trade at 55 euros today. So 5.5 times your money over that period. And I think that was an exceptional story, but I do think there are some others that look very similar. And one of the ways that I've invested in financials over the years is just to repeat old trades, see things and then say, what looks the closest to that. And I still think there are banks around Europe that may not go up 5.5-fold, but can certainly go up threefold by sort of following the same pattern that Unicredit has followed.
Right. And so that means there are other trades out there and they're not all the same. I think like when rates were zero, everybody felt, well, you can't invest in banks because they don't have the opportunities to lend. And now you're seeing differentiation.
Yeah, so I mean, maybe it'd be worth just touching on why banks make more money when rates go up. Because I think that's really, really important, in terms of why this can continue. So when rates are zero, basically on the liability side, they have deposits, and you can't charge people. Well, you can, but it's very difficult to charge someone for having a deposit. So your deposit rate is zero, and because rates are also zero or negative, you've got no spread. So as rates rise, what you do is you obviously increase what you charge on the loan side and lag on the deposit side. And obviously, if you've got customers that are happy to leave money in checking accounts for free, in essence, you've got your shareholders' equity, which is in essence free from cost, your spread widens. And that's what you've seen across Europe is, these are traditional banking businesses with retail and corporate deposits, generally lent out in mortgages and SME lending, which tends to be relatively short term relative to the US. So as rates go up, you're constantly increasing what you can do on the asset side and hopefully lagging materially on the liability side. And what we brought to the party, I think, from an analytical point of view, was we said that in a low rate environment, a higher rate than we've been in, we still think that customers will be happy not to really receive that much from their bank. Obviously, in the US, you got to a situation where rates in nominal terms got to a level where people said, actually, I'm going to move this, which is sort of regional banking crisis, some of the issues that Schwab and others have had. But in Europe, that never really happened because rates, even though they've gone up, never got very high. And the other thing that happened was that there's just a huge amount of savings. The savings ratios just went up enormously. And these banks have become so liquid that they didn't need to compete. So as the asset side went up, they were able to keep rates very, very low on the savings side. Now, obviously, as rates start to come down, that margin compresses a little bit, but they have a big offset. And that big offset is that they carry bond portfolios, which they reinvested at extraordinarily low levels, or in some cases, some didn't. And now they're able to lock in much higher returns than they've got on the existing bond portfolio. So I just use Barclays Bank here in the UK as an example. They've got 250 billion, which has an average maturity of 5 years, which yields today 200 basis points for the overall portfolio. You go on your Bloomberg screen, and you'll see that 5-year swaps in the UK today are just over 4%. So every day, as that portfolio rolls mechanically, they're earning a bit more than their existing portfolio. And it's actually better than that in the short term because the stuff that's rolling at the moment is actually closer to 0 than 2. So you get this just mechanical pickup in the profitability of these businesses because of the long end being higher, offset to a certain extent by short rates coming down. But our view here is that short rates don't go down that much more from here. Long rates remain kind of in this area. You're in the kind of nirvana for banks with strong levels of profitability and extremely low credit losses. And the extremely low credit losses come from the fact that these guys just haven't really lent any money for decades. And where they have, it's been very, very low risk. They haven't, they've learned the lesson from their commercial real estate lending of the the 1990s and early 2000s, and where they have lent over the last couple of decades or since the global financial crisis, principally in mortgages and principally in low value or low loan to values, sort of 50-60% loan to values. And so there isn't really much lost content in these balance sheets anymore.
Actually, I wanted to touch on that a little bit because, when we started this rate cycle, this hiking, there was a lot of speculation that banks in the US and in Europe were really going to struggle under massive credit, particularly real estate credit losses.
Yeah.
And that never happened. And I knew there were pockets, right? I mean, you were short something, we're not going to say what, on the shopping center side of things in Europe. But why did that not play out, or why was it not material?
Yeah, I mean, we were sort of right and wrong. We were right on the banking side because genuinely we felt that the banks weren't the owners of a lot of this commercial real estate debt. A lot of it had been passed into the bond market. So in general, we weren't that concerned about particularly the European bank sector. As you say, there's a number of smaller banks that had the greater exposure. We're actually short one in Europe still today. But on the sort of commercial real estate stocks themselves, our thesis had been that these guys had levered up enormously when rates were very, very low. In Scandinavia, some of these guys had borrowed money. Their average borrowing cost was like 1%. And obviously, as rates went up, we thought that would be very, very damaging. I guess two things have happened. One is that the economy's actually remained extremely benign. So we thought what would happen as rates rose, that these guys wouldn't be able to refinance themselves because people would be scared of the quality of the asset. In general, that hasn't happened, and people have been the assets have survived. And then the sort of second element is that people have been very willing to keep lending to them in the main. I mean, there's obviously exceptions in offices in San Francisco or wherever it may be, which have, absolutely cratered, and, the borrowers have taken enormous hits. But if I look across Europe, these businesses have been allowed to survive. So I do think there are some sort of zombie commercial real estate companies where if rates don't fall further, they will really struggle from an operating point of view. The terming of their debts means they won't go out of business tomorrow, but over time, I still think there is an issue. And, I'd be happy to be short some of these guys again, but it all comes down to the same sort of issue as that we had during COVID, where, most of us thought that there would be massive losses. The fact that the consumer was able to be as strong was obviously aided in that case by fiscal spending, and the damage just wasn't done that we thought was going to be done.
Yeah, it really, we saw it a little bit in the US, right? Where we saw some of these banks have trouble right away, and then quickly the regulator came in. Signature Bank, First Republic, a couple of others.
Yeah, I mean, they had more, I mean, generally in bank runs, it's caused by people worried about the asset side of the balance sheet, the risks on the balance sheet. Those regional banks had other issues in terms of how they positioned themselves in terms of interest rates. And when you look back, it was pretty crazy, the amount of, on their asset side, how they'd locked in low rates into their balance sheet. And then, given the size of their depositors, and the sort of the ability of people to hear from others what was going on, you had these sort of exceptional bank runs. Something that actually, we said at the time, and I hold firm today, is that just couldn't have happened in Europe. Not only are the banks structured very differently, from a regulatory point of view, they could never get in that position to take that interest rate risk that those US banks were able to take. And frankly, the big US banks aren't able to take either. So, the mega banks in the US, from Bank of America, JP Morgan, etc., are never taking the same risks as a Silicon Valley bank.
Maybe a quick aside, I'd put this in my notes, but Credit Suisse collapsing is just an extraordinary thing in my view, because you and I have grown up with Credit Suisse as a pillar, of the financial system, and the fact that the final thing was that they lent too much money to a hedge fund is also extraordinary to me. But it probably had a huge effect on realignment in Europe and probably helped the incumbents, the UBSs, UniCredit, and others. Go ahead.
Yeah, I think for me, Credit Suisse was the sort of last remaining bad apple that had never really properly been cleaned up. So I certainly wasn't surprised. I'm also more nervous of those kind of businesses, heavy investment banking businesses, enormous balance sheets relative to what I'd call more vanilla type businesses. But look, the European investment banking business has been under pressure from the US the US players for multiple years. They were the laggard in that, and I'm not surprised that happened. But I do think now there is an opportunity, if we do move towards some kind of more capital markets union in Europe, that the remaining players here have the opportunity to do quite well. And that won't mean that the US don't continue to be very strong, the Goldman Sachs, the Morgan Stanleys, and JP Morgans, etc. I just think the size of the capital market in Europe could change quite meaningfully from here, because the way we're structured here in Europe is that the banks are the core of everything, deposits and the lending side, and the capital markets here are just way smaller. I was looking at some data about securitization. There's less securitization now in Europe today than there was in 2008. In the US, there's multiple times more. And that's obviously, securitization is an example of increasing velocity on a balance sheet. And increased velocity is very helpful in a financial system. And we need to set out rules that make that easier for participants to do.
I mean, it's kind of ironic, actually, that because the Trump administration, if you think about where they're moving to, one of the areas that's been just a huge boon to the U.S. has been our capital markets, and think how many names in Europe and UK that have actually relisted in the United States. That may be behind us, but we'll see.
Yeah, I mean, you know as much as I do that it's always dangerous to write the US off, but I do think at the margin money has gravitated to the US at an increasingly fast velocity. When people look at their portfolios and their businesses, maybe they'll feel it's risk management that they might look at other places.
Yep. Hey, Johnny, maybe you could go back to Trump for a minute, just because not to, obsess about it, but I do think that I've never seen a scenario where we have now challenging so much orthodoxy from the past, meaning like, they floated this Mar-a-Lago Accord, which may or may not be real. But just how much people are addressing the U.S. debt situation, which they clearly think is unsustainable. The currency, we've had a strong dollar policy forever, and that looks to be waning. We may be a weak dollar policy for, we'll see. How does that affect what you do? I mean, you look globally, you invest everywhere. You own U.S. banks, you own European banks, you own Japanese banks. What do you think?
Well, I think as I say, it's always dangerous to say things are changing, it's different this time. But I also think that when you're in these situations where you're trying to do as much as they are trying to do, that there are unintended consequences. I have read and listened to a lot about what they're trying to achieve, and a lot of it makes sense to me, but I'm also unclear how easy it is actually to achieve that. I think the answer is it's not easy. And many things could go wrong. So I was kind of alluding, therefore, that people maybe need to take some hedges out in the broadest sense of the word to maybe mitigate against some unforeseen situations that come out of that. But as I started the conversation, the thing that really excites me here is that it's really forced Europe and the UK, obviously, sitting next to Europe, to take some of the world's challenges more seriously, and has brought us together. And I think that's quite exciting from an investor point of view.
Yeah, agree. Can we switch to fintech? Because, I'm sort of fascinated. I know you invest privates as well. There have been some real winners in Europe in the fintech side, but overall, there have been so many fintech startups that have been losers and a few big winners. But I remember, I think Jamie Dimon said, why would you want to get into banking? It's a tough business. And maybe you could talk about all the money that went in the last cycle, and really you can count on two hands, really, how many big winners on fintech we've seen.
Yeah, I mean, I guess I've been as surprised as everybody else how incumbents have been able to continue to run businesses where the technology and the systems, as it were, are clearly outdated. But it is difficult to shift customers. People are comfortable in what they already know. And then within the banking space, you need a lot of capital and there's a lot of regulation. And that is really difficult if you are a, fintech startup, challenger, whatever you want to call it. So actually, one of the conversations I was having with another investor the other day was, particularly in smaller markets, I think it's nearly impossible to really grow these businesses, because ultimately your core cost, even if you have a low cost platform, is high, because you need all the central functions, you need all the regulatory stuff. So you need a very large area, a large sort of population to go after. So I don't think there's much surprise if I think back that some of the most successful fintech companies I've looked at are those that are in places like the US, where there's a big population, Brazil, Russia, or wherever, rather than somewhere like the UK. And the ones that have been successful in the UK are generally international businesses. So I guess you think about things like Revolut or whatever, but they aren't just a UK business; they are international businesses. So I think scale is really, really important. The scale you need, I think, is actually much bigger than people have perceived.
Yeah, and trust, right? I mean, that's probably the biggest thing.
Yeah, I mean, inertia. I mean, but I think, yeah, trust and inertia. I mean, I think it's probably sometimes difficult to break down between the two, but ultimately, it is amazing because I'm involved in still in a couple of private banking situations here, as you know, and one of those is offering deposits at 400, 500 basis points, kind of like around base rate. The equivalent product for Barclays and Lloyd's and NatWest is at like 150, 200 basis points. And the technology, etc., is way, way better.
Mm-hmm.
So why wouldn't someone just move and pick up 300 basis points? Well, the answer is they don't.
Yeah.
Because they're, ultimately one of the reasons is, most people's savings is a relatively small number, and they can't be bothered, frankly, to move from one to the other for a small pickup, even though it sort of sounds 300 basis points sounds a lot, but 300 basis points on £1,000 or £2,000 or dollars, whatever, probably ultimately doesn't make that much difference. But and similarly on the lending side, they'd rather just literally take a slightly higher rate and feel safe about the process than go elsewhere. But look, I think over time that gets broken down. But I think what I've learned is it just takes more money and takes way longer than people perceived.
Well, maybe we could switch a little bit because your area is so interesting because it's bottom up, but it's also very top down, right? These are leveraged businesses, and I think what's going. We've talked about Europe and the U.S., but how about outside of that? I mean, Japan, there's a lot going on. Argentina, there's a ton going on. Greece, and in the same breath, when people mention Argentina and Greece, they talk about the banks immediately, right? That's the way to invest. So, what areas are compelling to you?
Yeah, what's true in a lot of these markets is the banks are sort of not only are the sort of conduit of the economy, but they're sort of in terms of market cap are the biggest. So they tend to be the things that people focus on. I'm going to give you a slightly boring answer because I think there are opportunities. Japan, in particular, with rising rates. We talked about what rising rates does, etc. I just feel like Europe has all the attributes that I need to make money at the moment. I simply do not need to be in Argentina and Brazil and et cetera, et cetera. Those are places that I've invested multiple times over the last 30 years. But the combination of the difference that I can get across Europe, from the UK to the core to the periphery, and obviously within the periphery, Greece. I mean, Greece, one of my biggest positions is a Greek bank. And I think that a lot of the things that I talked about earlier hold true. They benefited from cleanup of the balance sheets, they benefited from higher rates. But importantly, one thing we haven't talked about is the consolidation we've seen in these markets. So we've got kind of oligopolies in a lot of these markets. So Greece only really has 4 banks. I mean, if you ask them officially, I think they'll say they have 6, but 4 banks now control the whole market, and that's obviously very powerful from a pricing perspective, but it's also powerful from a cost perspective. So we talked a bit about the revenue side, I guess, in terms of interest rates and everything, but costs are also very important, and particularly if interest rates come down a bit, you've got to sort of protect your profitability. And the fewer banks there are and the better digitalization you have, the more control I think you can have about your cost base. So I think they've got it all in those economies. You've got the growth, you've got the profitability, and the last element that you're now getting is their ability to return capital to shareholders. And I still think that the market is some way away from understanding the magnitude in economies like that.
Go ahead.
I'm sorry, and then I'm not shocked, but I'm interested when I start talking to investors now that just haven't looked at these markets in a very, very long time. There is still an extremely wide or difference in understanding of these markets, whether it's Greece or Portugal or wherever, and so I think there's still a lot that needs to be learned, and I think that creates opportunity.
Well, okay, let's shift one more time because at the risk of really putting someone to sleep, can we talk about insurance just for a minute? Because
Sure.
there's nothing, if you want to really trigger someone emotionally, to talk about property and casualty insurance and my friends in California. But what is going on in insurance? And I'm seeing a lot of deals for insurance and reinsurance vehicles for investors promising extremely high returns, which look almost unsustainable to me. And it's not an area of expertise for me. Maybe you could tell me if it's a good time to be in insurance or what is going on.
So, I mean, obviously insurance is very wide, but if we sort of talk about reinsurance, at least firstly, and it's actually probably the most exciting, because if we talk about life insurance, we really are going to go to sleep. But I mean, pricing had been terrible for multiple years, and then has been, in simple terms, has been great on a sustained basis for a while. And I think the best insurers have been tucking away a nice amount of reserves to the point where even with the terrible wildfires that we've seen in the US, that they're pretty confident of being able to continue to generate substantial sort of mid-teens type returns. So I think you've got a bunch of unlisted private companies that now want to come to the market, who have built those levels of profitability. I think unusually in this cycle, there was not the amount of capital that we've seen in other cycles come in. Mm-hmm. And I think that's partly because when I look back at past cycles, people were looking for differentiated returns. I think they can find differentiated returns in other vehicles, and some of the sort of the success of the multi-strats, etc. Why not give money to a multi-strat than risk it in some cat sidecar? And sort of equally, the return profile didn't look quite as exciting as it historically might have. So the money hasn't come to the same extent up until really very recently, where I'm beginning to see a bit more coming. But ultimately, I think these are still pretty profitable businesses trading at discounts to where they've traded historically. And so I wouldn't say I'm overexcited about them, but I'm also not overly bearish either.
Hey, can we switch to you? And you're launching your business, or launched it, pretty substantial launch out of Europe, two big strategies. I'm not going to mention your returns on here, but you've done very well, my assessment, and beaten the index in Europe by a pretty wide margin. Can you talk about your record, how you achieved it? I mean, it seems like being long short in Europe has been a good thing, because you haven't had this mega tailwind like you had in the United States.
Yeah, I mean, look, as you know, I've done lots of things over the last, couple of decades in terms of trying to make money. The core of which has been the long short hedge fund, but I've done various sort of long only products and privates alongside that. What I've decided to do here is to really concentrate on the long short equity piece, partly because that's going back to sort of my roots at Tiger, but also when I sort of had time off last year, I thought about what had been successful, what hadn't been successful, and how I could run a business for the next 5 years, not the next 5 minutes. And I still believe that protecting the downside as an investor makes sense. I think there is real alpha out there. One thing that's true in Europe is that investors and banks had pulled back because there were great opportunities elsewhere, and there was more money to be made in the US and in tech and whatever. So I think the amount of investors, and maybe I would say some of the quality of investing is less here. I think that's an interesting starting point. And then the sort of additional point was that I've always invested in financials, so it's sort of my go-to anyway. But I think that you can have a competitive advantage in financials because the accounting is different, the regulation is different, the way the businesses work is different. So a lot of generalists that pull back out of this space aren't able to, or have not been willing, I think, to a certain extent, and maybe now are not able as quickly as they would like to really grasp the opportunity. And so that's why we're excited that we can, though we're new, we've got a bunch of people that have worked together, basically doing the same strategy as we have historically. And I think there's a good delta between where there's alpha on the long side and alpha on the short side. And that's, what we try to put together again.
Yeah. And Johnny, I know you alluded to it, that you short or that you have hedges. And maybe, and we've talked a bit about, why it's, these great ideas on the long side. Maybe you talk about shorting a little bit because, as much as we talk about all these relevant issues, all the scenario, the backdrop changes pretty rapidly.
Yeah, and look, that's in basic terms. I've been asked many times in the last few months, even, why don't I just run a long only strategy? And the answer in simple terms is there are always alpha opportunities, and the world does change. So why not give yourself flexibility to do that? But I mean, the short side to me doesn't look that different to the long side. And what we've tried to achieve historically, and what we're absolutely trying to achieve now, is to be unapologetically return seeking. We are not a low net fund that levers ourselves enormously, and that's not being disparaging about those guys, because many of them have been hugely successful, but we think we can differentiate ourselves from that. And within that, in a sort of more detailed way, what I find now is that when I go and meet companies, I'm welcomed with open arms, because I'm one of the only guys there that's going and looking at these companies on a 2 to 3 year view. There is now a very, very large focus on what's going to happen in the next set of results. And as I say, that can work. It's just not the way I want to work. And I just feel that on the short side, there are still a number of bad companies where, the accounting is bad, the business is bad. And we can take a, year, 2 year, 3 year view on that company, not just simply try and find a catalyst for why it might go down next month. And so the sort of thought process and the way we generate ideas is very similar. So some of which is looking from a top-down perspective on a sort of cyclical basis, sometimes on a more secular basis, and then obviously digging into the numbers in terms of accounting and so forth.
One thing I want to wrap up with just a bit, because I know you're a very proud Brit and love the UK. And I know you have a penchant for very long charts, because I know your 300-year UK rates chart, which I have somewhere on my wall. What about London as a financial center? How you've seen it change quite a bit. And now in the last, obviously the US has done quite well, particularly New York. But what do you think? I remember with Brexit, everybody thought, oh my gosh, we're all going to have to learn German and move to Frankfurt, and that obviously never happened. But what do you think the future is for the London as a financial center?
I think the future for the UK is decent still, because I think we have a bunch of very smart and well-educated people with a ingrained service industry that is hard to shift. It's a bit like my sort of comments about incumbent banks. It's harder to shift than you think. So yeah, look, I was not a supporter of Brexit. I remain a non-supporter of Brexit. I think it was a terrible idea, and it has caused us some meaningful damage in terms of business moving out of London. But having said that, we are resilient, and the economy has had its ups and downs. I actually think that what's going on in Europe will bring us closer to Europe again. Will we rejoin Europe? Probably not anytime soon. But I do think that the connections over particularly defence. People need to think about who can defend who, and the UK has a strong history in defence. And we have nuclear weapons, which many of the other Europeans don't have. So I think and we have a good defence industry. So I think all the things that are happening today gives us a slightly stronger hand than we've had for a while. And obviously, if business is pushed out of the US for whatever reason, the time zone, the language, the service basis puts the UK in a reasonably decent shape to take advantage of that. And as I say, I think the government here has surprised me positively in terms of how they've gone about things. I think if you looked at them from a sort of historic basis, some of the things they've done are much more conservative than Labour. And some of that is just simply a reflection of what's going on in the world order and what President Trump is forcing other governments to do. But there is a very strong pro-growth environment here today, which we haven't seen for a very, very long time. I'm sure there'll be ups and downs in it, but I feel pretty positive that that should be certainly more beneficial than we've seen for a while.
And God forbid, hopefully we get a good peace deal in Ukraine and we start to rebuild it. And it could be another component. I was just thinking about about Germany and what they're doing. And then if you actually have to rebuild what's been lost in Ukraine, you may get some growth.
Yeah, and that also flows obviously into Eastern Europe as well. So I mentioned that like there's certain banks like Commerzbank, for example, has a Polish business. Obviously, there are listed Polish businesses and banks, etc., and other Eastern European ones. So we are very linked into the east of Europe, and if those flows happen both from a infrastructure building in Ukraine, but all those defense spending, etc., I think there's some pretty large ripple effects. So the way I'd encapsulate this is to say Europe hasn't been solved. There are still meaningful problems with the construct of Europe, but for the first time in a long time, there are things that you can point to which feel more positive than negative. And then within that, the financial industry is in a maybe not the perfect world, but as I said, as you mentioned, the sort of stars have aligned in terms of where rates are, where credit is, etc., to give us a playing field which is about as interesting as it's been in 20 years.
Well, Johnny, I always learn something, so I really appreciate you doing this podcast with me, and thank you very much.
Thank you for supporting the Thematic Investors podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.